Welcome back to Economy Decoded. I am your economic architect. Ladies and gentlemen, the economic ledger is open. What you witnessed this morning wasn't just market volatility. It wasn't a natural correction. It was a clinical, high-frequency execution. It was a robbery. Look at the chart with me. In the morning, the world was celebrating. For the first time in human history, silver breached the $80 mark, screaming toward a peak of $83.62. The headlines were ready, the retail FOMO was at a fever pitch, and then, in a single violent session, the floor vanished. $80, $78, $75. A total collapse to 72 in a matter of hours. An 11% intraday wipeout. The tape just lied to you. While you were watching your screens in horror, wondering if the great silver bull of 2025 just died on its feet, the institutions were doing something else entirely. They weren't panicking, they were harvesting. If you sold today at $73 because you were scared, you didn't just lose money, you handed your seat at the table to someone who understands the math better than you do. Do the math on your screen right now. Silver is up 181% year to date. Gold, by comparison, is up a mere 73%. When an asset goes vertical upon vertical, rising 30% in the month of December alone, it becomes a target. Today, the Relative Strength Index, or RSI, was screaming at an 89. In the world of macroeconomics, an RSI of 70 is overbought. An RSI of 89 is a flashing red siren that a liquidity flush is imminent. But why today? Why December 29th? Ask yourself why this happened exactly 2 days before the January 1st deadline. What happened this morning wasn't just profit-taking. It was a triggered cascade. The CME Group, the masters of the game, raised the margin requirements on silver futures for the third time this month. They moved the bar to $25,000 per contract. Think about the mechanics of that. If you're a leveraged trader holding a position and the exchange suddenly demands $3,000 more in collateral per contract while the price is dropping, you have two choices. Find the cash in minutes or get liquidated. The algorithm saw the blood in the water. They hit the sell button, triggered the stop losses of thousands of retail investors, and created a margin call cascade that fed on itself. This was a bear trap of historic proportions. Is the bull run over? That is the question flooding my inbox. The fear in the comments is palpable. People are calling this the 2011 repeat. They remember when silver hit $50 and collapsed. But I told you at the start, I do not offer hope, I offer math. And the math of 2025 is nothing like the math of 2011. In 2011, the CME raised margins 5 times in 8 days to kill a 30% rally. Today, they are trying to contain a 181% explosion. But here's the difference. In 2011, the silver vaults were full. Today, the ledger shows a very different story. Look at the COMEX registered stocks, down to 24.8 million ounces. Now look at the outstanding futures positions, 200 million ounces. That is an 8-to-1 leverage ratio. For every 8 people who think they own an ounce of silver on paper, only 1 actual ounce exists in the vault for delivery. What we saw today at $72 wasn't a lack of demand. It was a desperate attempt by the paper markets to shake the physical holders before the most important date in the history of this commodity arrives. I'm talking about the Red Dragon's deadline. There's a reason the physical price of silver in Shanghai was trading at $90 an ounce today, while the COMEX was crashing to $72. An 18 arbitrage gap. That isn't a market. That's a broken system. The East is hungry for physical metal, while the West is playing games with paper contracts. Ask yourself, if silver is crashing, why is the gold-silver ratio still compressing? Gold held steady today, barely flinching, while silver was being taken behind the woodshed. Historically, when silver is about to make its real move, it becomes hyper-volatile. It shakes the weak hands. It punishes the impatient. Look at the psychological support levels. We hit $72 and bounced immediately back towards $75. Why? Because $70 to $72 is a massive Fibonacci retracement zone. It is the line in the sand. Every institutional algorithm on Wall Street has a buy order sitting at $71.65. If you sold at $72, you sold to a machine that was programmed to take your silver the moment you blinked. You're being told that the industrial story is over. They want you to believe that the solar manufacturers and EV producers have all the silver they need. They want you to ignore the fact that we are entering our 5th consecutive year of a structural supply deficit. But I'm looking at the data from the Silver Institute right now. The 2025 deficit is projected to hit nearly 150 million ounces. The cumulative deficit since 2021 is now over 800 million ounces. That is an entire year's worth of global mine production, gone, vaporized. So, was today the end? Or was it the last chance to get in before the gates close on January 1st? The technical rejection at $80 was expected by anyone who understands market cycles. You cannot go from $60 to $80 without a retest of reality. The market needed to breathe. It needed to flush the weak longs who were trading on 20x leverage. Now that they are gone, the path is clear. But the real story, the reason you should be wide awake right now, is not about margin calls or RSI levels. It's about what is happening in the shipping lanes of the South China Sea. It's about a policy change that is less than 72 hours away, a policy that will effectively remove 70% of the world AS refined silver from the reach of Western buyers. The media is calling it a licensing requirement. I call it a geopolitical noose. Stay with me. We are going to decode the why behind this crash. We are going to look at the secret positions of UBS and Goldman Sachs, and I am going to show you exactly why the China factor is the most dangerous variable in your portfolio right now. If you think today was wild, you haven't seen anything yet. The ledger is just starting to get interesting. The tape told you one story today, fear. But the data tells a completely different story, calculation. To understand why $80 turned into $72 in a heartbeat, we have to look past the flashing red numbers on the COMEX and look east. We are currently 72 hours away from January 1st, 2026. On that day, the global silver market changes forever. China has officially pulled the trigger. They are moving from a quota system to a restrictive licensing framework for silver exports. Now, the mainstream media is calling this administrative or procedural. Don't be fooled. This is the China factor. Look at the qualifications they've set. To get a license to export silver from China starting Thursday, a company now needs to produce at least 80 tons annually. They need a $30 million credit line. They need specific ISO certifications. On paper, it looks like raising standards. In reality, it effectively disqualifies hundreds of small and mid-sized refiners who provide the secondary liquidity the West relies on. Why does this matter to you in Chicago or New York? Because China controls 60% to 70% of the global refined silver supply. By locking down these licenses, they aren't just regulating, they're creating a state-controlled bottleneck. They are using the rare earth playbook on silver. They are prioritizing their own solar panel dominance, their own EV infrastructure, and their own semiconductor fabricators over the global market. They are effectively telling the West, if you want our silver, you will pay our price. And what is that price? Look at the Shanghai Gold Exchange right now. While you were watching the flash crash to $72, physical silver in Shanghai was being bought at over $90 an ounce. The Chinese aren't selling, they are hoarding. They are front-running their own policy. The 18 gap between the paper price in the West and the physical price in the East is the most honest indicator of value in the world right now. Ask yourself, why would a smart investor sell at $72 in London when they can see the metal is worth $90 in Shanghai? They wouldn't. This crash was designed to shake out the retail tourists before the export gates slam shut. Now, let's look at the institutional ledger. While the headlines were screaming about a collapse, what were the big banks doing? Let's pull up the internal notes from UBS, Goldman Sachs, and Citi. UBS just upgraded their targets. They aren't looking at $72. They are looking at a mid-2026 target of $65 as a floor with spikes toward $70. They are explicitly telling their high net worth clients to favor being long and to use any dip into the 50s or 60s as a strategic entry point. They see the 2026 deficit hitting nearly 300 million ounces. Then there's Goldman Sachs. Their analysts are calling silver the primary strategic metal of the green transition. They're projecting silver to average $85 to $100 in 2026. And Citi? They are the most aggressive of all. They've observed a massive rotation. Institutional money is moving out of gold, which has been the safe play, and into silver and copper. Why? Because silver is growthy. It's a hybrid. It is a monetary insurance policy that also happens to be the literal conductor for the 21st century. Do the math on your screen. We are entering the 5th consecutive year of a structural supply shortage. This isn't a theory, it's a physical reality. In 2024, the deficit was 148 million ounces. This year, 2025, we're looking at another 117 to 150 million ounces of shortfall. Since 2021, the world has consumed 800 million ounces more than it has mined. That's nearly 1 billion ounces of silver that used to sit in vaults that is now sitting in solar grids and EV batteries. It's gone. It's not coming back to the market. And here is the byproduct problem the sellers today don't understand. 70% of silver isn't mined as silver. It's a byproduct of mining copper, lead, and zinc. This means silver supply is inelastic. Even if silver hits $100 an ounce tomorrow, a copper mine isn't going to produce more silver unless the price of copper makes it worth it. Mine output peaked in 2016 at 900 million ounces. In 2025, despite record prices, we are struggling to hit 830 million. The supply cannot respond to the price. It is physically impossible to bridge the gap in the short term. So, why did the price crash today? Look at the January 1st deadline again. The institutional banks know that once the China export ban, licensing requirements, takes effect, the physical availability of silver in the West will dry up. The COMEX vaults are already at 10-year lows. If you were a massive bank like Goldman or UBS, and you needed to accumulate millions of ounces of silver before the price went to $100, how would you do it? You wouldn't buy when the price is at $83 and rising. That's what retail does? No. You wait for a thin holiday trading session on December 29th. You wait for the CME to hike margins. You wait for the algorithms to start a selling cascade. And then, when the price hits $72 and the retail traders are panicking, you step in and buy the liquidity flush. You're being hunted by the very people whose research reports tell you to stay bullish. Think about the industrial panic happening behind the scenes. Solar manufacturers are looking at these China export rules and realizing their entire supply chain is at risk. There is no silver substitute for a high-efficiency photovoltaic cell. There is no silver substitute for high-end semiconductors. They aren't looking at the $72 paper price. They are looking at the Shanghai premium. They are looking at the 8-to-1 leverage ratio on the COMEX. They are realizing that the paper market is a lie and the physical market is a war zone. What happened today wasn't the end of the rally. It was the last great shakeout. The institutions are moving their chips to the center of the table. They are betting on the divergence. They know that gold provides the floor, but silver provides the ceiling. They know that while gold has no structural deficit, silver is running out of time. If you are holding physical silver or even unleveraged positions, ask yourself, has the supply deficit changed since 9 a.m.? No. Have the China export restrictions been canceled? No. Has the industrial demand from AI and EVs vanished? No. The fundamentals are stronger at 72 than they were at 80 because the froth has been cleared. The leveraged gamblers have been liquidated. The ledger has been cleaned. Now the question isn't whether silver will hit $100. The question is, who will own it when it does? Will it be the people who panicked at $72 or the institutions who bought their fear? Stay with me. In the final phase of this decode, I'm going to give you the roadmap. We're going to look at the $70 psychological floor, the path to $100, and the one black swan event that could send the gold-silver ratio to levels we haven't seen in 50 years. The system is being decoded. Don't go anywhere. The smoke is clearing and the math remains. You have seen the flash crash, you have seen the China factor, and you have seen the institutional buy-side orders sitting beneath the surface. Now we look forward. We look at the roadmap for 2026. Look at the chart with me one last time. We are currently testing the $74 to $75 range. This is the pivot point. If we hold this level, the bear trap is confirmed. If we break below $74, we are heading for a retest of the $70 to $72 psychological floor, a zone where the 50-day EMA and the 0.236 Fibonacci level meet in a massive confluence of support. But do not mistake a retest for a reversal. The divergence between gold and silver is your North Star. Gold is holding near its all-time high of $4,500, refusing to give back its gains. This is critical. Gold provides the floor for the entire precious metals complex. It validates the macro thesis. Central banks are buying 70 tons a month, currency debasement is accelerating, and geopolitical risk is at a decadal high. As long as gold remains in this power zone, silver is simply a coiled spring. Do the math on the gold-silver ratio. We started 2025 at 100.1. Today, even after the crash, we're sitting at approximately 60.1. In the 20th century, the average was 47.1. If silver simply mean reverts to its historical average while gold stays at $4,500, the price of silver isn't $72. It's not $80. It's over $95 an ounce. That is the gravity trade. And it is being fueled by an industrial engine that gold simply doesn't have. Ask yourself, where's the silver for the 243 million ounces required by the solar industry this year? Where's the silver for the millions of EVs hitting the road, each carrying double the silver of an internal combustion engine? Where is the silver for the AI server farms and 5G infrastructure? The world is trying to build a high-tech future on a depleted physical inventory. The roadmap to $100 is now visible. Phase 1 was the breakout past $50. Phase 2 was the parabolic run to $80 that we just witnessed. Phase 3, the supply shock phase, begins on January 1st when China AS export restrictions go live. When the Western fabricators realize they can no longer source physical metal from the East, they will be forced to the COMEX for delivery. And as we already decoded, the COMEX is a paper tiger. They have 24 million ounces in registered stocks and 200 million ounces in paper promises. That is the black swan. A delivery failure, a force majeure event. If the exchanges are forced to settle in cash because they don't have the metal, the paper price will become irrelevant. The only price that will matter is the physical quittance, physical price, the price you pay to actually hold the metal in your hand. We're already seeing the preview in Shanghai at $90. So what is the strategy? First, watch the $71.65 level. A daily close below this level would invalidate the short-term bullish structure and suggest a deeper correction toward $65. But if we hold $74, the next targets are $78, followed by a retest of the $83.62 high. Second, ignore the noise of the margin hikes. The CME can raise margins to 100% if they want to, but they cannot manufacture silver out of thin air. They can break the traders, but they cannot fix the deficit. Third, watch the rotation. Citi and UBS are already seeing the shift. Investors are moving from the store of value, put into gold, to the strategic necessity, silver. The ledger for 2025 is closing, but the books for 2026 are just being opened. We are moving from a market of speculation to a market of physical desperation. The $8 drop today was a gift to the disciplined and a death blow to the leveraged. In this system, you are either the architect or the building material. You either understand the math or you are the liquidity for those who do. The system is decoded. Subscribe to Economy. Decoded to stay ahead of the shifts before they hit the tape. We will be monitoring the January 1st implementation of the China export licenses in real time. I am your economic architect. The economic ledger is closed for now. Disclaimer. I am an AI persona and this is not financial advice. Gold, silver, and markets are volatile. The information provided is for educational and entertainment purposes only. I am not a financial advisor. Always conduct your own research or consult with a professional financial advisor before making any investment decisions.